Sunday, 7th of September 2025. We are looking at relevant costing. Relevant costing. What are relevant costs? Relevant costs are the differential future cash flows. Relevant costs are differential future cash flows that arises in direct consequence or consequences of decision. Relevant costs are differential future cash flows that arises in direct consequence of decision. Relevant costs are differential future cash flows that arises in direct consequences of decision. It means all costs that are relevant in decision making must possess these features. Costs that do not meet these criteria are not relevant. It said differential. So differential means changes. The word differential means changes. It means for a cost to be relevant, it must be a changes cost. Relevant cost must change with the level of activity. That means they are variable in nature. Changes costs are variable. That means relevant costs are what? They are variable costs. By virtue of their nature, they varies. By virtue of their nature, they change. They did not remain fixed. Relevant cost did not remain fixed. So it means cost that it means general fixed costs are not relevant. So costs that are generally fixed are not relevant. So that is differential. We said they are differential future cash flows that arises in direct consequences of decision. And I've told you that differential means changes. The change with decision. As your decision increases, as you intend to produce more, then more of such costs will be incurred. When you produce less, you incur less of it. That is differential. Number 2 is future cash flows. Future cash flows. By virtue of their nature, relevant costs are future costs. They are future costs, not past costs. Not those costs that have been incurred before the products are launched. Relevant costs are not costs that have been incurred before the products are launched to the market. They are not costs incurred before the decisions are taken. They are not past costs. They are futuristic in nature. All relevant costs are futuristic in nature. They are not past costs. That means past costs are not relevant. Costs incurred before the products are launched are not relevant. Examples of sunk costs, those past costs we refer to them as sunk costs. Examples of sunk costs include the preliminary expenses, the research and development expenditure, the past costs, research expenditure, those costs are not relevant. Then we say cash flows, future cash flows. It means relevant costs are cash flows. By their nature, they are cash flows. No cash items are not relevant. No cash items. What are examples of non-cash items you used to have in accounts? Depreciation, yes. Amortization, depreciation, yes. Yes. Loss from disposal of an asset. Profit from disposal of an asset. Accruals. The non-cash items are not relevant. Thank you. So that is, for a cost to be relevant, it must be a cash flows. That is why we say they are future cash flows. Relevant costs are what? Future cash flows. They are future costs and they must be what? A cash flows. So, number 3 concept is direct consequences of decision. Direct consequences of decision. What does that mean? By direct consequences of decision, it means the purpose in which those costs are incurred must be because of the product or project under consideration. That is direct consequences of decision. That means these costs must not be incurred for any other purpose other than the decision you are about to make. Your decision might be to produce a particular product. It means the costs that are relevant to those products or that product must be the cost incurred because of that product. That is direct consequence of decision. You are incurring those costs because of the product, because of the project under consideration. They are not incurred for any other purpose other than the project in question. From the definition of relevant costs I've given you, we've identified the major features of relevant costs. We said, what are the features? The first one is differential. That is, we said differential means changes. The second one is future cash flows. They must be futuristic in nature and they must be cash flows. And the third one is direct consequences of decision. That is, you must incur them only for the project in question, not for any other purpose apart from that project. So we want to look at the basic concepts of relevant costs. Basic concepts of relevant costs. Number 1 concept we'll be looking at is materials. Materials or direct materials. What are materials? Materials are the substances. Materials are the substances from which goods are manufactured. The substances from which goods are manufactured. Now you use materials in production. The substance, the major thing you use in production, we refer to them as materials. Now, in connection with the materials, what are relevant costs of materials? Now, for the purpose of this lecture, we will categorize materials into two. Bought-in materials. Bought-in materials and existing materials. Existing materials. These are the two divisions or classes in which we will divide materials into. What are bought-in materials? Bought-in materials. Bought-in materials are the materials that are specifically purchased. Materials that are specifically purchased for the project. They are specifically purchased for the project. If these materials are bought for the project, that means the purpose of purchasing them, the purpose of acquiring them, why do you acquire them? Because of that project. You are incurring them for the project. That means they arise in direct consequence of that project. Since they were specifically acquired, specifically purchased for the project, it shows that they arise in direct consequence of the project. Therefore, it is a relevant cost of that project. So such material, bought-in materials, are relevant. The second classification we'll be looking at is existing materials. Existing materials. Existing materials are materials that are held as inventories. Materials that are held in inventories. Existing materials are materials that are held in inventory. So what does that mean? That means you have them as what? Stocks. You store them there. They are in your store. You are not just buying them. You have bought them sometime in the past. Maybe you have used some of these materials. Those who are not used, what will you do? You store them. So we refer to them as what? Existing materials. It means the new project you have in question now, you are not just purchasing this material for the new project in question. Are you following me? So we refer to that as what? Existing materials. Don't forget, we said relevant costs are what? Future costs. Future cash flows. That's why we said differential future cash flows. If the materials we are looking at here, if it have been bought sometime in the past, that means the costs associated with those materials are what? Past costs. Ordinarily, we would have said they are not what? Not relevant. We would have said they are not relevant. Now, but for our purpose, we want to look at the different costs of the existing materials. Number one, cost price. By cost price, we mean the purchasing price. Cost price of the existing material is what? The purchased price of that materials. Are you just buying them? Are you just buying the material now? No. They have been bought in the past. As at the time they were bought, the price they were bought, that is what? The cost price of that material. And since it has been bought sometime in the past, that means the cost price of that material is a past cost, is a sunk cost. And we say past costs are not relevant if you go by the concept, the definition. So since that cost price, the purchase price of that material have been incurred in the past, that cost price is not relevant. That is for the cost price. Number 2, we said this is not relevant, Abi. Yes. The second is replacement price. Replacement price. Replacement price is the current market value of the item. Replacement price is the current market value of the item. What does that mean? If you want to buy the same material now, the amount you can get it in the market is the replacement price. Is the current market value of the material, of the existing material. It means if you want to buy them currently, the amount you can buy it, that is what? The replacement price. Now, one thing I want you to bear in mind is this. If that material, if you regularly use it, if you don't have the one in stock before, if it were not in stock, won't you buy another one? Therefore, at what price? At the current price. Current price, which is what? The replacement price. Where the question tells you that the material is used regularly. Where it can be ascertained from the question that the material is used regularly. The current replacement price of the item is a relevant cost. Before you can use the replacement price, the question must have told you it is what? It is used regularly. If it is used regularly, that means if you don't have it in stock, you will have to buy another one for usage. And that new one that will be bought at their current market price. That is the replacement price of the existing material. When do we use the replacement price? Where it is what? Used regularly. Where it is being used regularly. Because if you don't have it in stock, you will have to buy the one that you will use for the job or contract. So, the third price to consider is the net realizable value. Net realizable value. Net realizable value. The word realizing is an accounting term which means to sell. It means to sell. And the word net in accounting means minus. The word net means minus. Realize means to sell. It means the amount you can sell that existing material now if you want to sell them. How much will you sell them? 1,000. But to sell them, you might have incurred certain expenses. The expenses you incur in selling them, you subtract it from the amount it was sold. If you sold it 1,000 and you incur 200 in transporting it to the point of sales, that means how much did you get from it? 800. You sold it 1,000. You transport the item to the point of sales for 200 naira. That means the amount you actually get is 800, which is the net realizable value. Now, when will you consider this as a relevant cost? When will you consider the net realizable value as a relevant cost? Then I've told you this means sellable value of the item, the amount you sell the item. When will you think of selling the item? When will you think of selling the material? When you don't need it. If the question can tell you that this material is no longer required, the relevant cost will be the net realizable value. If the question can tell you that you don't need it again, if you don't need it, that means the only option left is to do what? To sell them. To sell them. the amount you get from the sales of that item minus the selling expenses will be treated as what? A relevant cost of the project. That is where it can be ascertained that the what? The material is no longer what? Required. That is when to use what? The net realizable value. Hope you are getting the concept. I made mention of disposable value. But disposed means to sell. But if the question say disposed of, it means to do what? To throw them away. Not describe value. Call on the waste management to help you to dispose of the waste. That means you will even incur expenses in disposing them of. Is because you have to care must be taken when you are considering the net realizable value. If you see disposed and you see disposed of, they are two different concepts. So when you incur expenses in disposing them of, that is the cost of disposing them of is also a relevant cost. Let me say disposed of. The cost of throwing them away, just like engaging in service of waste management to help you to pack them and dispose them off. So that is relevant, but you will treat that as minus. You will not treat that as plus. You subtract the cost of disposing them off. Apart from that one, now every other cost I have considered, you treat them as plus. You treat them as plus. It's only the cost of disposing them off that is minus. Even the net realizable value will still be plus. The only one that is minus is the cost of disposing them off. That is materials. Then you can still have the opportunity cost. Let me add that opportunity cost. Opportunity cost of the existing materials. Opportunity cost, you used to call it what? Alternative for God. Yes. Now, if you have been using material A in production and you discover another material that can be used as what? As a substitute for material A. That means you have alternative. So you may want to consider the one that is more beneficial to you. Yes. You forgo one in order to do what? In order to get another. That is opportunity cost. Though we will still explain the concept of opportunity cost, and then we illustrate it further when we get to that. Opportunity cost is always a relevant cost. It's always relevant. It's relevant. So that is material. After materials, the number 2 concept I want to examine is labor. Labor. What are labor? Labor. Labor is a human effort. A human effort. Human resources in production, human effort. It can be a mental effort, it could be physical effort. Skill and no skill. All those, we refer to that as labor, mental or physical. So it's a human effort both mentally and physically used in production. And the reward for labor is what? Wages or salaries. So, in connection with relevant costs, we want to look at the relevant costs of labor. we will categorize this labor into two. For our purpose, we have full-time labor and part-time labor. So we are starting with the full-time labor. This class of labor, we refer to them as salaried workers. What they receive is what? Salary. So this work for salary. So, and the salary you pay them is fixed. And if you look at the definition of relevant cost I've given to you, I say they are differential changes. If salary is fixed, the salary you pay to full-time workers, if they are fixed, that means it is not relevant. It is not relevant. If the salary you pay to full-time labor, full-time workers, if it is fixed, it is not relevant. Unless we are based on their normal working hours, where the full-time staff will not be able to complete the job, you make them to work extra time. That means you will have to do what? You have to pay them for what? Overtime. The overtime you pay them is a variable cost, because if you don't engage your full-time staff, if you did not make your full-time staff to do the job overtime, you will need some other people that will come and perform a temporary service for you, Abi. Yes. And you have to pay them. So that is why that overtime is what is relevant. But their basic pay, which you must pay them as a full-time staff, is not relevant. But how do you know if the categories of labor, if it is a full-time? Where you are told that a spare capacity exists, spare capacity exists. Where spare capacity exists, you know that the labor is what? Is a full-time labor. It means within their normal working hours, the full-time staff, within their normal working hours, they will be able to complete the job. You understand? Yes. You know that that labor is what? A full-time. Number two, you have part-time labor. Their only reward is wages. I've told you the reward for full-time labor is salary. So these people, their own compensation is wages. And wages is a variable cost. The wages is a variable cost. While the salary is fixed. Salary is fixed. You can say, okay, I will pay you 10 naira per unit. It is part-time staff that you will say, okay, based on the unit you produce, I will pay you 10 naira. But full-time workers, if their salary is 100 naira, even if they did not produce anything, you will still pay that 100 naira. You are surprised. You say, you are not a civil servant. Sir, those times that you people go on strike, are you not getting paid for that time that you are not working? As a full-time staff, the time you were not working because you were on strike, you will still be paid for that period, won't you? Yes. It is because you are full-time. But the part-time staff, if they did not work, no pay. No work, no pay. I believe you understand the difference. So, part-time labor, I've told you they receive wages. And their wages is what? Is a variable cost. And the variable cost, the wages paid to a part-time workers is differential in nature. And I've told you relevant costs are differential for your cash flows. So the wages of the full-time is a relevant cost. How do you know if the work is a part-time? Where spare capacity or spare time does not exist. No time to spare. No, they are what?
No, I do time.
No, I do time. But for full time, there could be idle time. You see some of them, some of you in office, you will sit down with you will even leave your office for another office. And you'll be there discussing with your friends for hours. So, part-time labor. I've told you they receive wages. And the wages paid to a part-time workers, I said it is what? It is what? A variable cost. Therefore, it is relevant. Then we also have opportunity cost of labor. In terms of material, I talked about opportunity cost. Yes. Then for labor too, we have opportunity costs. If this is your staff, you engage your staff for full time, and your staff is currently earning 10,000 naira. But you have another project elsewhere. Your staff, if you second him to that new project, his job will be here waiting for you. That means the only thing that can make his assignment to be done here is if you engage another person to go and do the work there temporarily. But now, you did not have anybody that had the skills required in that project. The only person that has the desired skill is the staff you have employed. Now, remember your staff used to earn salary of what? 10,000 per month. So, and you now employ someone to come and stand in for your staff here for that month that project will be done. You now have to employ someone temporarily. The staff you have, your permanent staff, used to earn 10,000 per month. The person that you will employ to do the work on temporary basis, and you have to pay him 12,000 naira. The person now came to stand in for your what? For your staff in his own position. Yes. To do his normal job for that month. While your staff travel to that place of the contract. And what you will still pay that staff is what? Is 10,000 naira as what? Salary. But what is the opportunity cost of his own service? His own normal job? How much?
10,000.
It's 12,000 naira. The 12. Why are you incurring 12,000 naira? Because you want that staff to go to that project. It means if you do not engage that staff if you do not second that staff to go and perform that job elsewhere, then you will employ someone whom you have to pay 12,000 naira for there. Therefore, the opportunity cost of the project is the 12,000 naira you will have to pay the person that is standing in for your staff in his own duty. So the relevant cost is how much? 12,000 naira. That is opportunity cost. I've told you, opportunity cost is always a relevant cost. It's relevant. Till thy kingdom come is relevant. Now, number 3. I want to examine sunk costs. That is number 3. Okay, this is 1, 2, 3. Sunk costs. When we say sunk costs are past costs. sunk costs are past costs. If you go by the definition of relevant costs I've given you, I've said relevant costs are what? Differential future cash flows. Because of the word future, and this one is past cost. So it means any sunk costs are not relevant. Examples of sunk costs include the preliminary expenses. Preliminary expenses. Research expenditure or development expenditure. Those sunk costs are not relevant. Number 4, you have plant and equipment. We apply the same principle we've applied to materials, to plant and equipment. So we will only categorize plant and equipment into two: bought in plant and equipment, and existing plant and equipment. Bought in plant and equipment, as the plant and equipment specifically purchased for the project. They are the plant and equipment specifically bought for the project. So it means the purpose of acquiring this is for the project, no other reason. Without the project, this plant and equipment would not have been bought. Therefore, the purchase price of the bought-in plant and equipment are relevant. This is relevant for decision making. Existing plant and equipment. They are plant and equipment that have been bought sometime in the past, not for the project. That means if you have this, you keep them at their depreciated cost. I mean, in your financial statement, yes, you have cost less what? Accumulated depreciation. So, I will say relevant costs are future costs. That means the cost price of the existing plant and equipment, they are past costs, and not relevant. The nebu value is also a past cost, and it follows the accounting principles, which is not a cash flows. You know, it is cost less accumulated depreciation. The nebu value of the existing plant and equipment is not also relevant. It's just an accounting derivatives. It does not involve cash flows, so it is not relevant. But we have the scrap value. The scrap value of existing plant and equipment. That is the amount you can sell them. If you want to sell them because you no longer need them, so it should be treated as what? A relevant cost for decision making. Then we also have trading value. Trading value. Because the plant and equipment is aging, it's getting old, it's getting worn out.
It's becoming obsolete.
As it is aging, it may not have the capacity, it may not have the strength required to perform that assignment. And even if you want to use it by fire by force in that job or contract, you may be incurring loss of maintenance cost. Instead of you keeping that since you'll be incurring maintenance cost that is out of proportion. Instead of keeping it, you might decide to sell it. But the new one, remember, it may be expensive currently. The new one might be 100 million. And you might get someone to buy the existing one 5 million from you. How much will you add to it to be able to buy the new one? 95 million. The 95 million that have to be added is a relevant cost. We refer to that as a trading value. The trading value of the existing plant and equipment is a relevant cost for decision. Are we there? That is for plant and equipment. Then number 5, we have general fixed overheads. General fixed overheads. General fixed costs. General fixed costs. These are fixed costs that are generally fixed in nature. Costs that are generally fixed in nature, we refer to them as what? General fixed overheads. For instance, if I'm incurring 1 million naira as rent, and that same amount might be payable annually, so it is fixed.
Yes.
So, we say relevant costs are differential costs. Since this one will not change over time, it is not relevant because they are not differential. It is not relevant. That is for general fixed overheads. General fixed overheads is not relevant because they are generally fixed in what? In nature. Number 6, specific fixed costs. Specific fixed cost. It is specific. The costs are fixed. Normally they are fixed. But these costs were incurred because of that project. Because of that decision, you are having additional elements. For instance, if a class in St. Matthias is 300,000 naira. A class in St. Matthias, the amount I'm paying for a rentage of a class is 300,000 naira. Let us assume I'm only operating the skill level, and this 300,000 class can only contain 50 students. Now, if I want to get more than 50 students, maybe 52 or 53 or 55 students, I will have to look at the cost I want to incur. Should I keep only 50 students so that I will not incur more of the fixed costs? Remember, if I keep 50 students, I will incur 300,000 naira as what? As rent. But if I want to now have 55 students, I may have to get additional class. Are you following me now?
Yes.
So, the additional class might attract, let's say 100,000. I will now decide whether to restrict my students to 50 or to get the 55. If I now want to, I want to take decision now. I want to decide whether to do what? To take exactly 50 students. So that my rent will not what? Will not increase above what? 300,000. Or to accept the 55 students and incur additional 100,000 as rent. Why does my rent increase? My rent will now increase from 300,000 to 400,000 if I'm now having 55 students. Why does my rent increase? Because I am getting or I'm engaging more students than what? Than planned. I planned for 50 students. But I'm increasing my students to 55. That is the reason I'm incurring additional 100,000 naira. That means the reason for incurring the 100,000 is as a result of the decision I'm about to make. The 100,000 is specifically incurred because of that project. Without that project, the 300,000 I've been incurring before is the amount I will still be incurring.
Yes.
But because of the new project now, which is the new intake of additional 5 students, my cost now increased from 300,000 to 400,000. The 100,000 is directly related to the 5 additional students being engaged. That is specific to that. So a specific fixed cost is relevant. So this one will be treated as what? A relevant cost. Relevant cost of admitting 5 additional students. So that is specific. So it's relevant. Then another one that is still similar to this specific is avoidable. Avoidable cost. I have avoidable fixed cost. Avoidable fixed cost. We can still check them to mean the same thing. Avoidable fixed costs are the fixed costs that can be saved. Costs that can be what? They can be saved. That means you can do without them. You can avoid them. You can do without them. If you want to do without them, what will you do? How will you do without them? Not to accept that option. Just reject that option. That is the only way you can do without it. It means if you want to accept that option, that project, that decision, they will be incurred. Those ones you can do without, they are avoidable. And that means the purpose of incurring them is as a result of what? It means these costs are indirect consequence of the decision you are about to make. What decision? Whether to accept it or to reject it. If you accept it, you will incur it. If you reject it, you will not incur it. That means they are incurring direct consequence of the project. Therefore, avoidable fixed costs are relevant. These costs are relevant to the decision. Number 8. Opportunity cost. So there is one song everybody used to sing, and if I ask you the song, I want to believe every one of you knows it. What is opportunity cost? And your song will be what? Alternative what? Forgone. So, there is alternative. You apply opportunity cost anytime there is what? Alternative. When there are objectives, multiple choice question is alternative. There are alternatives. You have to choose one out of the alternative. If you are given A, B, C in your, and you want to shade your answer, objectives, maybe you might either go for B and leave A and C. So that means you apply opportunity cost where there are what? Alternative. And you have to weight the 2 alternatives or the 2 or more alternatives you have. You weight them. You weight them in your hands. You carry the one with what? The heavy weight. The one that is more beneficial to you. Yes. That is opportunity cost. That is how to tackle opportunity cost. You go for the one that is most beneficial. So if you weight them, when you choose one, you neglect the other. That means you forgo another one. But in the concept of decision making, we often calculate contribution in relation to this concept. A contribution, is an influence, just like income. So, opportunity cost is the value of benefits. Value of benefits sacrificed in expense of others. The value of benefits sacrificed in expense of others. That is opportunity cost. The value of benefits sacrificed in expense of others. That is opportunity cost. You go for one, you neglect the other. So it means where it is possible to calculate contribution, you weight the contribution from your regular product. Contribution is 200 naira. You've discovered another one that will give you contribution of 300. What will you do? You will go for the one that will give you 300 contribution. Abi? Your regular product, only one of the two you have to choose one, not both. Either to go on with your regular product that gives you contribution of 200, or to divert to the new product. If you divert to the new product that gives you 300 contribution, what will happen to the contribution you used to get from your regular product? Yeah? It will be forgo. You forgo that one. Because you are forgoing that one for the new one, it is a cost of you going for the new one.
Cost of sacrifice.
It is a sacrifice. You have forgone that. You treat it as cost. It's contribution, which is an influence, but you treat it as what? Cost. Treat it. Just add it to your cost. You treat it as what? A relevant cost. So you have to weight the alternatives. I've told you opportunity cost, relevant cost in decision making. You want to take questions as work example?